Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I'm going to walk you through the process of valuing PBF Logistics stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. PBF Logistics is a master limited partnership formed by PBF Energy. The company is engaged in the processing, receiving, handling, storage, and transferring of crude oil. Let's get started with the model. This is a small cap company, 617 million market cap. They're trading at $10 a share, and they have 62 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has positive and growing free cash flow. It nearly tripled from 2017 to the trailing 12 months. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they also have positive and growing net income. Revenue is the sales for the company, and that does seem to be growing each year from 255 million to 361 million. The company has really good profit margins. Net profit margin is net income divided by revenue. It's how well you convert revenue into profit. In the trailing 12 months, they converted 37% of their revenue into profit. That means 63% went towards expenses. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference is the gross profit. And that was the lowest in the trailing 12 months. Below that is operating expenses. They had really low operating expenses compared to other years, so their operating income was the highest in the trailing 12 months. Below that is the interest they pay in their debt, and that's $50 million. Then below that is other income and expenses. When a company makes money or loses money outside of its core operations, that goes into other income and expenses. Asset impairments would go into this field. Below that is pre-tax income. They pay very little in taxes because they're a master limited partnership. To qualify as a master limited partnership, a business must receive at least 90% of its revenue from natural resources or real estate. This company received its revenue from natural resources, oil and gas. The bottom line of the income statement is their net income, and that was the highest in the trailing 12 months. This is the company statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And that seems to be growing up to $148 million in the trailing 12 months. The company pays a nice dividend, but another way to reward shareholders is to buy back stock. And this company seems to be buying back lots of stock, 230 million in 2017, 44 million, 100 million, then 135 million. They did issue 34 million and 132 million of stock. This company has a lot of debt, so they are issuing debt also to run their business. 200 million in 2017, 170 million, 228 million, and 132 million. Since debt is really cheap, a lot of companies are taking on debt to grow their business. Ways a company like this can grow its business is by investing in expensive machinery or acquiring other businesses. The most important part of any business is their operating cash flow. And this company seems to be generating sufficient operating cash flow, $130 to $170 million a year. And to calculate operating cash flow, you start with net income, that was $133 million. Then we add depreciation of $44 million. Depreciation is an expense on the income statement, but it's a non-cash item. That's why we have to add it back on the CFO section. We also have to add back 4.7 million of stock-based compensation and 4 million of other non-cash items. They also had negative 12 million in changes in working capital. This is changes in accounts payable, accounts receivable, inventory, things like that. Even though the company reported $133 million of profit, they actually generated $173 million of cash flow. That's why it's important that you look at the statement of cash flows in addition to the income statement. Let's look at a capital structure. 100 million of equity, 800 million of debt. So they're 12% equity, 88% debt. So they're really leveraged. Their WACC is 10.25%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $1.9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.7 billion. We divide that by 62 million shares, and we get a calculated stock price of $27. They're trading at $10, so they're trading at a 63% discount. It's a buy according to the model. Simply Wall Street values the company at $26, so they're in the same range as me. They're also saying the stock is really undervalued. The stock was trading in the low 20s for a few years, but then dropped off a cliff in March. It has come up a little bit, but it's still trading at a major discount relative to its all-time highs. This company was raising its dividend each year up to 52 cents, but they did cut their dividend down to 30 cents. Since the stock price has come down so much, their dividend yield is still really high at over 14%. Because the way you calculate dividend yield, it's annual dividend payment over stock price. So as the stock price goes down, the dividend yield goes up. Or if the stock price goes up, the dividend yield goes down. And the company pays out 67% of its net income and 60% of its free cash flow. This company has a beta of 1.76, so the stock moves almost 2 times the market. It's pretty volatile. The stock has gone down 53% in the past 52 weeks, much worse than the S&P 500. The low was $3, the high was $22, and the stock is trading above its 50-day and 200-day moving average. About 200,000 to 300,000 shares are traded each day for the stock, and of the 62 million shares outstanding, only 25 million are on float. About 25% of the shares are held by institutions, and a little under 3% of the shares on float are shorted. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $6,400 today. If you did not reinvest the dividends, you'd have $7,600. So as you can see, the stock is really volatile. It was down, then up, then it came down. Since this company pays a 14% dividend, if you bought the stock and it didn't move in price, you'd be making 14% a year. But if the stock doubled in price with the 14% dividend, you'd make a killing. The parent company for PBF Logistics is PBF Energy, and they own 48% of the stock. Then the next shareholder owns 11.5%, Invesco owns 5.5%, then Clearbridge, then Goldman Sachs. Let's look at the financial ratios. The average PE in the market's 11.4, the median is 14.4. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have a 4.7 PE, so investors are paying about $5 for $1 of earnings. Price to sales is stock price over sales per share. They have a great price to sales ratio of 1.7. Price to book is stock price over book value per share. They're at 6.0. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have 105 million of equity. They have 99 million of tangible equity because they have 6.3 million of goodwill on their balance sheet. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments almost 4 times. ROE is net income over equity. They have an amazing ROE, 127%. Current ratio is current assets over current liabilities. They can cover their current liabilities 2 times. Their current assets are 35 million of cash and 55 million of receivables. So it does appear that the company is capitalized enough to get through the year without taking on more debt. They had 150 million of free cash flow. They have 46 million of working capital and an $89 million dividend payment. So my calculation is they have $106 million if they do a similar amount of free cash flow in 2021. The best way to look at ratios to compare them to similar companies, I've done videos on 44 midstream companies, and PBFX is right here. PBF has a similar PE ratio. They're doing a little better in price to sales, a bit worse in price to book. They're doing better in current ratio at 2.0. The average is 1.4. And their ROE is through the roof. But they do have a lot of debt, 88% debt. But they're a real small company, 463 million market cap. And they pay a massive dividend, 14.35%. So to summarize, I have them trading at a 63% discount because the stock price has come down so much from its highs a couple years ago. I give their free cash flow 7 out of 10 because it's growing quite a bit each year, but it's still on the lower side. I give their revenue 6 out of 10. That's also growing nicely. I give their ratio 7 out of 10. Amazing ROE, but a bit too much debt. Anytime you invest in a company with under 1 billion market cap, I think it's pretty risky, and they're at 617 million. But to compensate for that risk, you're getting over 14% in dividend payments. So it's kind of a trade-off. You have to look at both ends of the spectrum. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.